Our channel is dedicated to spreading awareness on all things useful to wealth creation and finance. In this video, we would be sharing information on the different options to get the best returns on your investment. How to invest money to get maximum returns. 10 common investment options in India. The following list contains 10 investment choices popular among Indian investors. Direct equity, equity mutual funds, debt mutual funds, National Pension System, Public Provident Fund (PPF), Bank Fixed Deposit (FD), Senior Citizen Savings Scheme (SCSS), Pradhan Mantri Vaya Vandana Yojana (PMVVY), Real Estate, Gold. Direct equity. Stocks are a volatile asset class, capable of quick jumps within a short time period. As such, stock investors always consider the lack of return guarantees. Additional associated risks include the right investment timing, selling invested assets at the right time, and so on. However, as explained before, the high risks also translate into high rewards, much higher than inflation adjustments. Equity trading markets have options like stop loss to cut down on loss. In stop loss, one places an advance order to sell a stock at a specific price. To reduce the risk to a certain extent, you could diversify across sectors and market capitalizations. One needs to open a demat account for direct stock investments trading. Equity mutual funds. Equity mutual funds primarily invest in equity stocks. As per the Securities and Exchange Board of India, SEBI, mutual fund regulations, an equity mutual fund scheme must allocate a minimum of 65% of its assets to equity and equity-related instruments. Equity funds can be managed either actively or passively. Equity schemes are categorized according to market capitalization or the sectors in which they invest. In actively traded funds, the fund manager's ability to generate returns is key. Index funds and exchange-traded funds, ETFs, are passively managed, and these track the underlying index, Sensex or Nifty. Equity mutual funds can also be domestic, investing in Indian stocks, or international, investing in overseas stocks. Debt mutual funds. Debt mutual funds are ideal for investors preferring steady returns. They are less volatile and less risky in comparison to other equity funds. The funds are primarily invested in fixed interest generating securities like corporate bonds, government securities, treasury bills, commercial paper, and other money market instruments. These mutual funds are however not completely free of risks. Associated risks include interest rate risk and credit risk. National Pension System. The Pension Fund Regulatory and Development Authority, PFRDA, manages a long-term retirement-focused investment product, the National Pension System, NPS. It comprises fixed deposits, equity, corporate bonds, government funds, liquid funds, and more. The minimum annual, April to March, contribution for an NPS Tier 1 account to remain active has been reduced from 6,000 rupees to 1,000 rupees. Public Provident Fund, PPF. PPF is a long-term investment with a tenure of 15 years. Compounded tax-free interest leads to healthy returns, especially in the later years. Interest earned and the principal invested is backed by sovereign guarantee, making it a safe investment. PPF interest rate is reviewed every quarter by the Indian government. Bank Fixed Deposit, FD. Bank FDs are considerably a safer choice than equity or mutual fund investments. The Deposit Insurance and Credit Guarantee Corporation, DICORC, safeguards each bank depositor, ensuring them up to a maximum of 5 lakh rupees for both principal and interest amount. As per requirements, one may opt for monthly, quarterly, half-yearly, yearly or cumulative interest. The interest is a taxable income under Indian law. Senior Citizen Savings Scheme (SCSS). The Senior Citizens Savings Scheme is a popular option among retirees above 60 years of age. The elderly portfolio investment favorite can be availed from banks and post offices. SCSS has a 5-year tenure, which can be further extended by 3 years once the scheme matures. The upper investment limit is 15 lakh rupees. One may open more than one account. Interest earned on SCSS is payable quarterly. It is fully taxable. SCSS interest rate is reviewed and revised each quarter, but it remains fixed from the start till the scheme's maturity. Senior citizen can claim deduction of up to 50,000 rupees in a financial year under Section 80 TTB on the interest earned from SCSS. Pradhan Mantri Vaya Vandana Yojana (PMVVY). PMVVY is for senior citizens aged 60 years and above. The scheme provides an assured 7.4% return per annum, payable monthly, quarterly, half-yearly or yearly as per choice. The minimum pension amount is 1,000 rupees per month. The maximum is 9,250 rupees per month. The maximum possible investment amount is 15 lakh rupees. The scheme has a maturity period of 10 years and is available till 31st March 2023. The investment amount is repaid after maturity to the senior citizen. In the unlikely event of death, the money is paid to the nominee. Real estate. Real estate is one of the most profitable investment options available. But there are certain things to keep in mind. The home where you reside should never be considered as an investment. Rather, the second property can be considered as an investment. The location of the property is the single most important factor that will determine the value of your property and also the rental that it can earn. Real estate investments deliver returns in two ways: capital appreciation and rent. But, unlike other asset classes, real estate is highly illiquid. Another risk is obtaining the necessary regulatory approvals, though it has largely been addressed after the coming of the real estate regulator. Gold investment. Gold has long been used as a commodity for investment. Jewelry gold has concerns like safety and high cost, along with 6.25% making charge. Gold coins are better investment options. Banks offer gold coins on sale nowadays. An alternate way of investing in gold is through paper gold. Paper gold investments are more cost-effective and can be done through gold ETFs. Gold ETF trading occurs on a stock exchange, NSE or BSE, with gold as the underlying asset. Sovereign gold bonds is another option for paper gold investments. An investor can also make gold investments through mutual funds. That's all for today. Follow the next video for more updates. If you have liked our content, don't forget to like, comment or subscribe. Hit the bell icon for future notifications.